This video is on the 2025 Sole Trader final account, Connell. So as always, we're going to have 5 different steps that we're going to take in order to carry out the final account. So step 1, I would recommend that you lay out your accounts, and in the exam, on the day of the exam, it should take no longer than 5 to 6 minutes. Step 2 then would be to transfer the figures into the accounts from the trial balance, and that would take about 6 or 7 minutes. The third step is to calculate the investment income and the debenture interest for the year, and again that would be 3 to 4 minutes. Step 4 then would be to start on your adjustments, and you'd have about 32 minutes for that. And then the last step is to tot up the totals, and that should be 5 minutes, and the total time there 54 minutes. So the first 3 steps we're going to take a look at now. So the layout of the accounts, 5 to 6 minutes. I suggest that you, well before the exam, that you are very comfortable with this layout. So you can see here you've got the TPL on the left hand side and the balance sheet on the right. The TPL on the left hand side has all of the expenses and revenues for the year. So you think of it like a video recorder. Okay, it's recording all the expenses that have come in, all the revenues that have come in and all the expenses that have occurred during the year. Whereas the balance sheet on the right hand side is like a snapshot. It's like a picture of all the assets and all the liabilities that the business has at the end of the year on the 31st of the 12th. So about 5 to 6 minutes writing that down, and then at least you have like the foundations done. You have the layout done. You no longer need to think about the layout. Now it's very important that you get the order of things correct, especially from the finance buy down in the balance sheet. Okay, second step then, we're going to transfer the figures into the accounts from the trial balance, and this will take about 6 or 7 minutes in the exam. So you want to make sure that you're very well practiced, and then 6 or 7 minutes will do you. But as you're learning, it'll probably take you 10, 11, 12 minutes. Okay, so here is the 2025 question, the Sole Trader question. You can see the trial balance on the page on the left hand side, and then all the adjustments on the right hand side of the page. So the trial balance is the list of all of our balances at the end of the year. You can see there on the left hand side, the debit side, you have assets and expenses, and on the right hand side, the credit side, you have liabilities and revenues. So you can see at the top there that I have said that assets and liabilities, they belong in the balance sheet, and then expenses and revenues belong in the TPL. So going down through the trial balance here, you will have to know where all of these items belong, okay, where all these account balances belong. And so for you to do that, you really need to know the layout and be very, very, very comfortable with that. So land and buildings, it's on the debit side, which is the asset side here. So that is in the balance sheet, and that's a tangible fixed asset. Provision for depreciation, that is a contra asset. So it's a little bit of an exception to this alert rule here. So the ALER and then the T for the T account. It's a little bit of an exception for that rule because it's a contra asset. So what that is, it's basically just the asset land and buildings there decreasing. Okay, so it's just reducing the value of that. But the accumulated depreciation for the buildings also belongs in the balance sheet under tangible fixed assets. So tangible fixed assets are those assets that we can see and that we can touch, and they're fixed assets. Fixed assets are assets that are going to give us benefit for longer than a year, more likely like 5 years plus. So your delivery vans, your buildings, etc. So delivery vans, same place, balance sheet, tangible fixed asset. Patent, so just a piece of paper. It's a legal document to say that you own the rights to whatever the technology is maybe that you have developed, or a product that you have designed. Whatever it is, it just protects anybody else from producing the same thing. So a patent, legal document, intangible fixed asset at the top of your balance sheet. 3% investments, also on the asset side there, on the debit side, that is financial fixed assets in the balance sheet. Then we're on to debtors. So debtors are the people that you sell to on credit. So on credit means buy now, pay later. So you give them the goods today and then they owe you money. So they are a current asset. And then the creditors are people who sell you goods on credit. So you owe them. So debtors are balance sheet current assets, and then creditors go under creditors minus 1 year, because you have to pay those creditors within the year and your debtors have to pay you within the year. So they're short-term assets and liabilities. Stock on the 1st of the 1st is opening stock, and that belongs in the trading account in the TPL. Purchases and sales also go in the trading account. Now, the discount here. Discount is on the right hand side, the credit side. Okay, so discount net, that just basically means the balance of the discount account. So you could have a discount balance on the debit side, and you could have a discount balance on the credit side, the right hand side. It's on the right hand side here. So I know that that discount is a revenue. So if it was on this side, that discount would be an expense. So that would be discount allowed if it was on the debit side, but because it's on the credit side, that is discount received. Okay, so that is discount received. So that's really good. So you got a discount from your creditors. So you could have either balance, but just you receive more discount than you allowed in this year. So that's discount received, and we put all the other incomes that aren't sales, all the other operating incomes into the add operating income heading. The next thing then we have commission, and commission is a little bit like the discount, what we've just had here. It could either be discount paid or it could be discount received, okay? Because it's on the debit side, right, we have that it would be discount paid. So maybe we just paid sales staff commission for selling our goods, or maybe we paid a third party for selling our goods. So we just pay them a percentage of the sales price. So that there is commission paid. On the credit side, if it was here, it would be commission received. Okay, so maybe you sold goods for a third party and then they pay you. But because it's on the debit side, the left hand side, that is commission paid. And commission relates to our sales. So it is going to go under the selling and distribution expenses heading. Now, the next item then is rent. So like discount and commission before it, it could be an expense or it could be a revenue. Okay, so if the rent was on this side here, it would be rent paid, it would be an expense. If it was on this side, which it is, it would be rent received. So on the debit side, on the left hand side, under the expenses, you are paying your landlord some rent. But on the credit side, the right hand side, which is where it is, you are getting paid. So you are receiving money. Okay, money is coming in because of rent. So you have a tenant that rents space off you, and so you've got that, and it's for a certain date, and we'll be taking a look at that later. So income, rent coming in, rent received, goes under the add operating income heading. Okay, provision for bad debts. So this is another contra asset, like the provision for depreciation below, which basically just means that it reduces the asset, land and buildings there, but provision for bad debts reduces the asset debtors. So provision for bad debts is basically the company anticipating that potentially some of their debtors might not pay them. And they might just feel like they might not pay them because this has historically happened. So maybe over the years they have had debtors that have gone bankrupt and have not been able to pay them. So therefore the business is being prudent now. So it is being wise, and it is just anticipating losses, and they're putting it in the accounts. So we are going to take that contra asset, provision for bad debts, away from our asset debtors. And we'll do that where the debtors belongs, in the balance sheet current asset. So as always, our alert diagram up here, okay, our AL and then ER and then our T account. So our vowels are on the debit side here and our consonants are on the right hand side there. There are the couple of exceptions to the rule, such as the accumulated depreciation and the provision for bad debts. Okay, next we have salaries and general expenses. Okay, so salaries and general expenses, they're under the expenses heading, and it would be the admin expenses. So all expenses relating to sales goes under S&D, and all of the other ones would go under admin. Okay, then we've got insurance incorporating suspense, so we'll have an adjustment on that later, but insurance itself goes into the TPL admin expenses. Next, we have the 6% fixed mortgage, and this is on the liability side. Okay, so a mortgage is a long-term loan for a property, and so we owe that back to the mortgage provider, and it would be over like 20, 30 years, however many years. So a long-term liability that'll go in the balance sheet, financed by under creditors plus 1 year. The next thing we have is the mortgage interest paid for the first 9 months. So we had a mortgage for the entire year, but we've only paid for 9 months interest. So at the end of the year, we will have mortgage interest that we owe to the mortgage company. So we'll have 3 months mortgage interest due, and that will be a creditor minus 1 year. So that's going to help us work out how much mortgage interest we owe. So we'll see that now in the next step. The next one, we have advertising, and this is interesting. The bookkeeper has accidentally put investment income into the advertising account, which was a bit silly. Okay, so the investment income should have went into its own account, but it went into advertising. So we'll worry about that later, but we'll come back to it. But advertising itself, it promotes sales, so that will be S&D expenses. Now, next we have VAT, value added tax. So it's just a tax that is added on to the sale of goods and services. And it is under the asset heading. So VAT only ever goes in the balance sheet. We can have VAT as an asset if we have paid too much VAT, and the Revenue Commissioners then owes us a VAT refund. So in this case, McConnell has paid too much VAT, and they are due a VAT refund of 13,900. So if it was on the credit side, McConnell would owe the Revenue Commissioners some VAT. Next we have, that goes in the current assets. Next we have bank, and bank is on the liability side. So that means that they have a bank overdraft. So that will go under the creditors minus 1 year heading, as will PAYE, PRSI and USC. So McConnell as an employer has taken PAYE, PRSI and USC from his employees' salaries or wages, and he or she will then send it over to the Revenue Commissioners. So when it's on the right hand side, the credit side here, we will owe that to the Revenue Commissioners, and we'll obviously have to pay them that within the year, and then our debt to them will be done. Okay, now another exception to the rule. So here we have drawings and we have capital. So capital is a liability to the owner. Okay, so capital is money that the owner puts into the business, and so this owner here, M. McConnell, has put in €782,600 into this business. The business then, the business owes that back to M. McConnell. Like technically M. McConnell owns that 782,600 that they've invested into that business. So the business owes that back to M. McConnell. Now, the opposite of putting something into the business is taking something out of the business, and that is called drawings. So these drawings, 13,700, represents amounts that M. McConnell has taken out of the business by way of stock, or like maybe the business has paid for an expense for McConnell or anything like that, but that is just a reduction in the liability capital. So it just reduces capital, and you'll see it at the bottom of the finance by section in the balance sheet, and we will always take drawings away from the net profit figure. It's very important that that comes last. And next we have capital. So balance sheet financed by capital and reserves. So that is your trial balance. And what I say is, I reckon that best thing to do is just fire the figures in. All of these figures have marks attached to them. And so a lot of the time students forget to bring over some of the figures from the trial balance, or they take them down incorrectly. So my advice would be to just get them into place, right? Everything has a place, as soon as you can. And when you do this, you've got tons of marks banked, and you can just do all of your workings then from this standpoint here. So it's very easy then for you to check that you have written in the figures correctly. So a lot of students might transfer the figures from the trial balance incorrectly. For example, maybe they would say 65,200 instead of 62,500, and they could lose 2 or 3 marks then. So it's a good one to just get all this done. You're ticking things as you go along, and you can double check, and then you never have to do this step again. So that is my suggested step 2 complete. So in an exam, I would anticipate, if you had your timing down and you had practice loads, I would anticipate that this would take you 6 to 7 minutes. But when you're learning this, it's going to take you a lot longer than that. Okay, step 3 then, I suggest that you calculate the investment income and the debenture interest for the year, and this would be 3 or 4 minutes. So just to talk you through these, a reminder that the investments themselves, so this sole trader has investments, and they go in the financial assets section of the balance sheet. Now, those investments yield 3%, and they were bought during the year, okay? And the amount of the investments for the year, the investment income for the year, should go into the TPL. And it's important for you to note that it does not matter if all of the investment income has been received or not. We still have to write what relates to the current year here, okay? It's very important that you do that. Now, in every Leave Cert final account question, you are going to have investment income due. And so at the end of every year, you are going to be owed some investment income, and that will surely be paid to you within the year. So that's going to go in the current assets section. Now, next we have a mortgage. So the sole trader has a long-term loan. It's called a mortgage, and it's on a property. So the mortgage itself is down in creditors' amounts falling due after more than 1 year. So the 220,000 mortgage is placed there. Now, exactly like the investment income, the mortgage interest for the whole year is going to go here, okay, for the entire year. It does not matter whether we have paid it all or not, okay? And in every Leave Cert accounting question, you are never going to have paid all of the mortgage interest that relates to this year. And so whatever mortgage interest is due is going to go under the creditor's amounts falling due within 1 year section. So I use this as a step because I think it's very important to get those easy marks banked first, but I also want to create the habit in you to look out for investment income due and mortgage or debenture interest due in other questions on the course, because other questions on the course do not ask you to calculate investment income and mortgage interest due like the sole trader one does. So it's trying to create the habit that you're always going to be looking for it. So looking at the 2025 question then, we're going back to the trial balance, and we can see here that this sole trader had 3% investments, and they acquired or bought them or invested into them on the 1st of June 2024, and the investments amount were €120,000. So for this year, 2024, you had the investments for 7 months. So it started on the 1st of the 6th. So they had it for the 6th, 7th, 8th, 9th, 10th, 11th, 12th month. So for 7 months. So if you calculated that out, it'd be 120,000 multiplied by 3%, multiplied by 7 over 12, and that is €2,100. Now, if you remember from earlier on, this trial balance showed us that we received 3 months investment income, but the bookkeeper accidentally shoved it into the advertising account, but it should have went into its own account, into the investment income received account. So that was a bit silly. So if we were to put it into the investment income received account, what we would do is, well, we'd firstly know that the amount, the 3 months, would be €900. So you just multiply 120,000 by 3% by 3 over 12 months, and that's €900. But you would credit that, put it on the credit side. So investment income received would be 900 on the credit side. Okay, and now, as you know, our debits and credits have to equal, and if we just shoved 900 on the credit side, we would be out of balance here. So what we're going to have to do to fix that then is we're going to have to add that to the advertising. Now, I know that seems counterintuitive to what you want to do, because incorporating 3 months investment income, you think, oh sure, I'll just take that out to fix it, so I'll minus it, but actually because of the double entry, you have to plus it, and then your two sides will equal again. So this requires that you understand the debits and credits. So if the bookkeeper accidentally shoved it into the advertising account, okay, so imagine the advertising account was just here, minding its own business, all right, so advertising is here. But what the bookkeeper did by mistake, so I'll put the mistake in red, they put €900 into the advertising account, which was completely silly. And so if we wanted to fix that then, like just Tipp-Ex it out, what we'd have to do to balance it out is put €900 on the other side to just correct the wrong. So here you see here, plus 900 here. So we have received that 900 investment income, and it's important that we will record that we've received that, and we'll also have to fix the advertising by adding 900 on. And this was such a good change that they have made in the paper, because it's the first time really that we've seen something like this. We usually see this here in with the patents in past questions, but that's a lovely new challenging adjustment for you. So next we have the mortgage. So you can see here that we have 6% fixed mortgage, and that includes €70,000 received on the 1st of the 6th, 2024. So we have a mortgage of €220,000 now on the 31st of the 12th, but previously during the year we had 220 minus 70, which is 150. So they had €150,000 mortgage for the first 5 months of the year, up to the 1st of the 6th. But after that, okay, they had the 220. So you have to work out both of those amounts, which you can see over on the right hand side of the screen now. So you've got your 150 multiplied by 6% multiplied by 5 over 12, and that gives you 3,750. And then you add that to the 220,000 by 6% by 7 over 12, and that is 7,700. So altogether, that tots up to €11,450. So we're going to slot these into the accounts now. So as I said, the investment income for the year, so we had it for 7 of the 12 months. So the 7 of the 12 months, the 2,100, has to go into the TPL, even though we did not receive it all, okay? And the investment income due, then we're going to put this up into the current assets, because we're definitely going to have investment income due at the end of the year. So you've got the amount for the year, the 2,100, but we're minusing the 900 that had been shoved into the advertising account by mistake. And you'll see over here then, into the advertising, I'm adding the 900 so that we have now got the correct advertising figure. Okay, so that was a really tough one for students this year. Next then, we have the mortgage interest. So we have the 11,450. Now, I just haven't put it over here yet because there might be a drawings adjustment on the mortgage interest. So that is just something that is typical of sole trader final accounts. So I'm just anticipating that I might. But if you wanted to write in the entire like 11,450, that's fine. You just, if there's a drawings thing later on, you can just cross that out and write in the correct figure, whatever it would be. But anyway, 11,450 is the mortgage interest for the year, but we are definitely not going to have paid all of that. So we're going to have 11,450 minus the 7,400 that they have told us that they have paid in the trial balance. So we saw this in the trial balance that they had mortgage interest paid for the first 9 months, and that was 7,400. So look, getting these bits done early is really useful because you're banking up a lot of marks, and as well you're creating the habit of looking for investment income due and loan interest due in other questions on the accounting course, which is a really valuable skill to have. Okay, so that is steps 1, 2 and 3 done. Okay, the only thing that you've done to use your calculator is the investment income and mortgage interest. We've done no adjustments yet. So after you do each of these steps, you can quickly check that you've done that step correctly. And once you have all of those 3 steps done and ticked off that you've corrected them and you've checked them, double checked them, you can then move on to the adjustments. And in the know that you have got the first 3 steps completely done and completely right. And that's a really powerful thing to have, you know, the things ticked off, and now you know, okay, I can move on to my adjustments now. And if I've made a mistake anywhere here, I know that it's in step 4 in my adjustments. So you don't have to go back checking the entire question. So it's just a really good strategic move having them in steps like this. So in 2024 sole trader account, we had 9 adjustments. And I think feedback from students was that it was probably the toughest sole trader final account to date. And I would actually agree with that. I think there was a lot of challenges in this for students, but for well-practiced students, I think, you know, they could still have a really good shot at it. But yes, I definitely do think that it was a challenge for students. So look, we will get started. So first note then, first adjustment says stock at cost on 31st the 12th, 2024 was €84,000. This figure includes stock at a cost of €10,600, which was later damaged and now has a net realisable value of 8,300. So a gorgeous first adjustment for us, nice and easy. So all we're doing here is we are writing down beside our closing stock, we're writing down 84,000 minus 10,600 plus 8,300. And then we are also putting our closing stock under the current assets. So that is that part done. Second adjustment is patents are being written off over a 6-year period which commenced in 2022. So it's important to note that we are doing the books for the 31st of the 12th, 2024. So that means that the patent has been started to be written off in 2022. So 2022, it's been written off. 2023 has been written off. But now we're doing it for 2024, so it hasn't been written off for any more of those 6 years. So we've got 4 years left to write off. So the patent that you see here, the 62,400, that represents 4 years patents left. So 62,400 divided by 4 is 15,600, which you are going to put into the administration heading. Okay, so 15,600 is the patent written off for this year. And then we have to show up in our balance sheet, what is our patent worth now? So if at the start of the year it was worth 62,400 before we wrote it off, and took away 15,600. Now you've got 46,800 euro. So 46,800 euro. All right, so that is note 2. Note 3 then is the delivery vans adjustments, so no difference from all of the other years. Pretty standard, copy and paste, just change the dates and change the figures. So let's have a read. So provide for depreciation on delivery vans at the annual rate of 15% of cost from the date of purchase to the date of sale. Note, on the 30th of the 6th, 2024, a delivery van which cost 35,000 euro on the 31st of the 8th, 2022 was traded in against a new van which cost 48,000 euro. An allowance of 23,200 euro was given on the old van. The cheque for the net amount of this transaction was entered in the bank account but was incorrectly treated as a purchase of trading stock. These were the only entries made in the books. Okay, so what happens in every single sole trader final account, every single company final account, is that the sole trader or company wants to trade in, they want to trade in their old van and drive away in a new van. So they rock into the Ford garage or the Peugeot garage or whatever type of garage they want to buy their van from, and they bring their old van and then they drive out in the new one. So lots of information given to us here. One of the huge mistakes that has been made is just that nothing has been entered at all bar a mistake. Okay, so it said here that the cheque for the net amount of this transaction was entered in the bank account but was incorrectly treated as a purchase of trading stock. And this was the only entry made in the books. Okay, so look, what they're asking us to do in the first sentence is to just depreciate vans for the year. Okay, so we'll do that. But then they're telling us that they traded in their old van for 23,200 and then they drove out in their new van, which cost 48. But the bookkeeper noted that the amount that they paid for the new van to be able to drive out in the new van was incorrectly treated as purchases. So we need to fix purchases first. So let's have a look and see how we're going to do that. So we have a new van which cost 48, but they got an allowance of 23,200 for it. Okay, so the bank transfer, okay, or it was a check, sorry, the check was incorrectly treated as purchases. All right, so we would have debited the 24,800 and purchases is on the debit side. So for us to correct that and take that out of purchases, we are going to minus it. So we're minusing it because it was on the same side, double entry, as where they would have, where it should have went. So they did debit it. So for us to take it out of purchases, we credit it, which means we minus from purchases. Now, next we will find out what the cost of vans is at the end of the year. So they got a new van worth 48. They got rid of a van that cost 35. The vans at the start of the year cost 132. So what we're going to do from that 132 is we're going to minus 35 and add 48, and then we've got a cost of 145 then at the end of the year. So remember where this 132 came from. This came from the trial balance. Okay, now, so that's the cost of vans done. The next thing that we'll do is work out the depreciation charge for the year. Now remember, start of the year, for a period of time in the year, they had 132,000 euro was the cost of the vans, and then at the end of the year the cost of the vans was 145. So we need to think about when did they make this trade in. So you can see, okay, that they traded in on the 30th of the 6th, 2024. So halfway through the year they made that change. And the first sentence here says to provide for depreciation on delivery vans at the annual rate of 15% of cost from the date of purchase to the date of sale. So for us to calculate the depreciation then, we just take the 132 by 15% by 6 of the 12 months, which is 9,900. And then we take the 145 by 15% by 6 over 12, and we get 10,895 or 75. So altogether there, that is 20,775 euro. Now, another thing we have to do now is to work out the profit or loss on the sale of the old van. Sorry, the depreciation has gone away there. I'll be back in a minute. So profit or loss on sale of the old van. So every time we got rid of a fixed asset, and in this case it's delivery van, so every time we get rid of it, okay, we have to work out, did we make a profit or a loss on the sale of that fixed asset? So right now we're looking at the delivery vans, and we know that our delivery van that we had cost 35,000 euro on the 31st of the 8th 2022. And we got rid of it on the 30th of the 6th, 2024. So a very important thing for us to do is note, okay, how long did we have this delivery van for? And then we can work out the accumulated depreciation on that old van. So if we're looking at this, in 2022, we want to say, okay, how many months do we have it for? So we bought it on the 31st of the 8th. So we had it for the 9th, 10th, 11th and 12th. So for 4 months of 2022. Then in 2023, we had it for the entire year. And then in 2024, we had it for 6 months. So altogether there, that is 22 months. So we can work out what the accumulated depreciation is there. So the cost of the old van, 35,000. And then we want to calculate the accumulated depreciation. So 35,000 by 15% multiplied by 22 over 12 gives us accumulated depreciation of 9,625. So we bought that van for 35,000, and we anticipated, like we calculated our depreciation, that it would reduce the value of that van down to 25,375. So the net book value at the time of the trade-in, what we considered it to be worth, was 25,375. Now, we only got an allowance of 23,200 for it, unfortunately, which is less than what we thought it was worth. So therefore, we made a loss on sale of the delivery van, 2,175,000 euro. So that is the loss on sale of delivery van, which is a selling and distribution expense. Okay, last thing then that we have to do is we have to calculate the accumulated depreciation on all of the vans. So what this means then is basically, okay, we have vans that cost 145,000 euro. How much have they reduced in value over their lifetimes? Okay, so you have the accumulated depreciation from the trial balance, and then you're adding the depreciation charge for the year. And then what you're doing is you're taking away the 9,625 on the old van. And that tots up to 32,650, which means then that you have a net book value of 112,350 euro. So that van's adjustment is definitely worth, quite a few marks. So you have to make sure that you are very well practiced on that one. Okay, we are now on to note 4, and this was a really challenging one for students. So let's take a read. So it says, in late December 2024, goods with a retail selling price of 14,760 euro, including VAT at 23%, has been sold on credit. This was a markup on cost of 20%. No entry had been made in the books. The goods were not dispatched from the warehouse until the 5th of the 1st, 2025. Okay, so very challenging here, I think, for students. The first few words here, in late December 2024. So in other words, the very end of the year, and we're thinking closing stock, we're thinking goods have been sold on credit. So I'm definitely thinking closing stock. But the last sentence would have confused a lot of students. So the goods were not dispatched from the warehouse until the 5th of the 1st, 2025. So that sentence there is there to confuse students, all right? It is there to, make them doubt, oh, wait a minute, does this actually affect my closing stock now? And the answer is yes, it does affect your closing stock, because the goods were sold in late December 2024. So it doesn't matter that they weren't dispatched, that they weren't sent out from the warehouse until the 5th of January. It doesn't matter when they were sent to the customer. They were sold in late December 2024. So therefore we have to attribute it to 2024's closing stock because it was in late December. If it just said during the year, but had no link to late December or the 31st to the 12th, it would just be purchases, it would not be closing stock. But because it says late December 24, it is closing stock. And so the last sentence is just there to throw you, to make you doubt whether you have to reduce from closing stock. But yes, you do. Okay, because they were sold in 2024, late 2024. So you have to take them from the closing stock. Okay, so there's a lot more to this then, as well as just the closing stock query. Okay, so retail selling price of 14,760, that includes VAT at 23%, and that has been sold on credit. This was a markup on cost of 20%. No entries being made in the books. Okay, so we just have to enter all of this now. So we have sold goods on credit to our debtors. All right. So we sold on credit, buy now, pay later. It's to our debtors. So 14,760 was the amount inclusive of VAT. So 14,760 is 123%. And that includes VAT. And that is what is charged to the debtor. We charge the debtor the amount inclusive of VAT because we are going to later send the VAT amount to the revenue commissioners. Okay, so the debtor, you're going to charge them the amount inclusive of VAT. So the sales price then would be the 14,760 divided by 123 and multiplied by 100. So the sales price is €12,000. And that means then that the VAT amount, the 23%, is €2,760. Now, we have to find out the closing stock as well as this, but let's have a look at the T accounts here. So the debtor is an asset, increases on the debit side, as you can see there, 14,760. So you've got 123% on the debit side, the left-hand side. And the revenue, sales, okay, increases on the credit side, the right-hand side, and that's the 12,000, which is 100%. And then the VAT account, okay, we are going to record the VAT on the same side as the item it is attached to. In this case, it is attached to sales. And so you can see now that we have 123% on the debit and the credit sides of the T accounts there. Now, I think it's important at this stage to do the T accounts because the majority of students are unsure of whether to add or subtract the 2,760 from the VAT. So we go over and we look at the trial balance, and you can see that the balance of the VAT in the trial balance is on the debit side, the left hand side, and that is 13,800. So that would be on this side here. So when we come to enter the 2,760 into the VAT account, we will minus the 2,760 because it's on the other side of the T account. Now, we can't forget about the closing stock. So the closing stock, okay, is whatever it was before we put the markup on the cost. So the selling price was 12,000, and remember this is a markup on cost of 20%. So 12,000 is now 120% because it's got 20% profit margin on top of that. Multiply it by 100, and the cost price then is €10,000. So there is a lot going on in this adjustment, and it definitely tricked a lot of students. So let's have a look at how it looks in the accounts. So to the debtors in the current assets, we add 14,760. To the sales, we add 12,000. And then remember, we said the VAT, we were going to minus the 2,760 because it was on the opposite side of where the VAT balance was. And then our closing stock, we're going to minus the €10,000 here. Now you can see my workings has just come over a little bit of the columns here. You don't have to worry too much about columns. Personally, I don't draw columns, but you just need to have your workings nice and neat, and you know, just make sure that it's very visible for the examiner to be able to correct. But you've got tons of room there. Okay, and then obviously your closing stock is going to be affected in your current assets as well, but we have already written closing stock as per TPL, so whatever we have here, we will be putting it into the current assets as well. So that's note 4 done. Okay, note 5 now, we are on to the suspense adjustment. So the suspense figure arises as a result of the incorrect figure for mortgage interest, although the correct entry had been made in the bank account, and a payment of 5,400 towards PAYE, PRSI and USC entered on the incorrect side of the bank account. Okay, so we're going to use the trial balance to help us here and do this in a nice quick way. So we'll look at the first mistake first. So the suspense figure is basically, where did they shove the mistake? All right, so the bookkeeper made a mistake earlier on and the trial balance did not equal. Okay, so this here did not equal, the trial balance didn't equal. And so what the bookkeeper did then to try and get it to balance, they just shoved the mistake into the insurance account. So what we have to do, we have to correct the mistakes, and then we will have the correct insurance figure, and then we'll have no mistakes. So the first thing here is as a result of the incorrect figure for mortgage interest, although the correct entry had been made in the bank account. Okay, so mortgage interest, first of all, we can see here that we have 6% fixed mortgage, including 70,000 received on the 1st of the 6th, 2024. So we saw that earlier on when we were working out the mortgage interest for the year. But here it says mortgage interest paid for the first 9 months of the year. So they said, the bookkeeper said that it was 7,400, but you know, because the adjustment tells you that that is incorrect. So the correct amount went into the bank account, but the wrong amount went into the mortgage interest paid account. So 7400 is incorrect. So if we worked out what the first 9 months of the year is, we had to be very careful this year. This was a bit of a tricky calculation, because we had 150,000 for the first 5 months of the year, and then we had 220,000 for the next 4 months of the year. So altogether we had 8150. 8150 is the mortgage interest paid for the year. So you can obviously see then that the bookkeeper made a mistake. They only said that it was 7,400. So what I do, I want to add whatever I need to add to that 7400 in order to make that 8150. And if I add 750, that will equal 8150. Now, that would put my two sides, my debit and credit sides, out of sync. Okay, because the debit side is now 750 up. So what we're going to do, we're going to look at our item incorporating suspense, and we are going to minus the 750 in order to get our two sides to balance again. So that is the first error corrected then. We'll slot them into our accounts shortly, but we can use this trial balance to help us fix it. Okay, the next error that we're going to fix then, it says a payment of 5,400 towards PAYE, PRSI and USC entered on the incorrect side of the bank account. So a payment of 5,400 towards PAYE, PRSI and USE entered on the incorrect side of the bank account. Okay, so what should have happened here? If we made a payment towards PAYE, PRSI and USE, that would be money coming out of our bank. So that's what should have happened. We should have credited the bank. We should have put 5,400 on the right hand side of the bank. So what happened by mistake is that the bookkeeper put it on the wrong side of the bank account. So they put it on the left hand side, the debit side. So in order for us to come and mop up all the mistakes, fix all their mistakes, then we are going to have to put 10,800 on the credit side of the bank account, which is us putting in the original 5,400, but then correcting that mistake by putting 5,400 on the opposite side then. So that's 10,800 euro altogether on the credit side. So if we look at this bank figure here, all right, that's on the credit side there. We are going to then, because that's on the same side, we are going to add 10,800 to that. And now, as you know, your two sides are unbalanced now again, because you're after adding 10,800 onto the credit side. What you're going to have to do then is add 10,800 on to the debit side of the insurance. Okay? And so that is what we're going to have to do. We've got all the workings done here. We've used the trial balance to help us. And this is a really quick way of us completing this adjustment. You know, we want to find really quick ways of doing things. We want to work smart and not hard. Okay, so I've got the trial balance just here for us to see, so you can see here what's happening to the insurance. We're going to minus 750 and add 10,800. The mortgage interest paid for the first 9 months, you can see there was 7,400. So what you can do is just rub that out and then minus 8,150, or you can just put a bracket around the 7,400 and add the 750, but make sure the minus is in front of that, so you're actually minusing the 8,150. Whatever you want to do, just make sure you're minusing 8,150. And then the bank, you are plussing the 10,800 there. And that is the suspense adjustment complete. Okay, so it's a really handy trick of doing it really quickly, and the trial balance, using the trial balance can ensure that you don't make mistakes, that you're plussing and minusing correctly. All right, note 6. So this is a lovely one. Okay, a check for 1,600 had been received on the 31st of the 12th, 2024, in respect of a debt of 3,200 previously written off as bad. The debtor wishes to continue trading with Connell and has agreed to pay the other half of the debt within 1 month. No entry was made in the books in respect of this transaction. Okay, so it's practically guaranteed. You know, you'd see a bad debts written off or bad debts recovered adjustment in every final account, whether it be manufacturing or sole trader or company. Okay, so expect to see it. This one here is bad debts recovered, because a debtor who was previously written off as bad, who previously went bankrupt, is now back in business, and they've given us 1,600, half of the debt that had previously been written off as bad, and they said to us, come here, we'll give you the other half. Okay, they've promised us the other half, so that's really, really good. So we have 1,600 coming into the bank, so it's going to go into the asset bank account on the debit side, the left hand side, and then our debtor has promised to pay us the remainder, the other half, so we're going to increase the debtor 1,600 on the debit side. And then we're going to have, you need to see from the T accounts there, we need to have the same debits and credits. Okay, so 3,200 on the debit, 3,200 on the credit. And so bad debts account, if you had a bad debts account and the balance was on the debit side here, that would be overall an expense, so that would be like bad debts written off. If the balance was on the credit side, the right hand side, that would be a revenue, that would be bad debts recovered. So in this case, it's bad debts recovered because we are getting money back to us, so we are happy out about that. Now you can see here that the bank is an overdraft, all right, so it's a liability on the credit side, so it's an overdraft. So money coming in to our overdraft is going to reduce the overdraft. So you will see here then we're adding the 1600 to the debtor. Because the bank was an overdraft, we're minusing the 1600, and then we've got bad debts recovered 3200 in our ad operating income. Okay, note 7. Goods taken by McConnell for his own personal use during the year were not recorded. These goods had a retail value of 12,900, which is cost plus 20%. So goods taken by McConnell for his own personal use during the year were not recorded. These goods had a retail value of 12,900, which is cost plus 20%. Okay, so this is a drawings adjustment. So drawings is when an owner takes something of value from the business. So whether it be like stock or whether it be that the business pays for an expense on behalf of the owner or something like that. So that is drawings. Now, the biggest mistake that people make here, it's not calculating it out. They're very good at calculating it out. So the cost price, we want to find out the cost price of this, 12,900 divided by 120 multiplied by 100 gives us a cost price of 1070. So people generally get this correct. The biggest mistake is that students read this and they say goods taken by McConnell for own personal use during the year. They read this and they say closing stock as well as purchases. Students always take drawings from closing stock, I have found. But it is not closing stock because this adjustment has not mentioned anything about the end of the year. It hasn't mentioned 31st the 12th. It hasn't mentioned like in late December. It hasn't mentioned, anything about closing stock. So when you see goods accompanied with the words during the year, or like during 2025 or during 2024, whatever it might be, that is purchases only. Okay, so what we're going to do here, we are going to take the 10,750 away from purchases and we are going to add it to drawings. So we are crediting the purchases account, minus in it, so crediting the purchase account, and we are debiting drawings. So when we take goods from the business, we debit drawings, so DD, debit drawings, and then we credit the purchases, which means we minus from the purchases. So that is a nice and easy adjustment. But again, some students put it into closing stock. There's no need for it to go into closing stock at all. So just bear that in mind the next time you see that. Okay, now note 8. So this was a challenging buildings adjustment. So it says a new warehouse was purchased during the year for €102,150, which includes VAT at 13.5%. The amount paid to the vendor was entered in the land and buildings account. No entry was made in the VAT account. Provide for depreciation on buildings at the rate of 2% of cost per annum. Land at cost was €100,000. It was decided to revalue the land and buildings at 1.1 million on the 31st of the 12th, 2024, and this has yet to be reflected in the account. So we are going to break it down bit by bit because we have to, all right? There's just too much there for us to try and navigate all at once. Let's just break it down, sentence by sentence, chunk by chunk, and then we'll move on. So the first part, the new warehouse was purchased during the year for 102,150, which includes VAT at 13.5%. Okay, so this figure here, the 102,150, this represents 113.5%. So what should happen in this scenario is that the asset buildings, all right, should be increased by 90,000, which is 100%, okay? And then the VAT attached to that should go on into the VAT account on the same side. as the buildings, okay? Now, it doesn't say anything about the bank account being treated incorrectly or anything, so we can assume that the 113.5% was credited from the bank account. So that's what should have happened, okay? The buildings debited 90, the VAT debited 12,150. But that is not what happened. What happened by mistake is that the amount paid to the vendor, who is the person that sold it, was entered in the land and buildings account, okay? So, and that no entry was made in the VAT account. So this is what happened here by mistake. So into the buildings, they put the 113.5%, okay? And then they put literally nothing into the VAT account. Okay, so 0% in there. So that was the mistake. So we have to come along now and we have to fix it. So we need to get from 102,150 on the debit side to 90,000 on the debit side. And we'll do that by putting 12,150 on the opposite side to reduce this down. You know, so if you put 12,150 on that side, you would get 90,000. And then the VAT, we put nothing in the VAT, but we need to have 12,150 on the debit side of the VAT. And so there, that is there. So your VAT in the trial balance is also on the debit side. So the trial balance is on the balance is on the debit side. So what you're going to do with the 12,150, you will be adding that 12,150. And so that's that. It's pretty easy fix, but it is, you know, there's so much scope for getting it wrong. So from the buildings, you're going to minus the 12,150, and then the VAT, you're going to add 12,150. Okay, so that is the first part done. The next part then says provide for depreciation on buildings at the rate of 2% of cost per annum. Land at cost was €100,000. Okay, so we have to remember now that our buildings, right, 870, but minus the 12,150 now, okay? So we have to reduce the land and buildings down by 12,150. And then what we have to do, we also have to take out the 100,000 land, because we do not depreciate land. Okay, they're not making any more land, and so we don't depreciate land. Land would just appreciate in value. So it's only the depreciation on buildings that ever occurs here. So 870 minus the 12,150 minus the 100,000 land, and then we multiply that by 2% and we get 15,157. Now what we're going to do then to that, we're going to add the 15,157 to the 95,000 accumulated depreciation. That's the second part done. The last part then is it was decided to revalue the land and buildings at 1.1 million on the 31st of the 12th 2024, and this has yet to be reflected in the accounts. Okay, so they want the land and buildings to be 1.1 million. All right, so previously, you know, we had that our land and buildings were worth 870 but minus the 12,150, and then all of this depreciation had taken place on these land and buildings. But now we've had somebody come in from external and they have said, look, your land and buildings are definitely worth 1.1, so you need to put that into your balance sheet. You need to show that increase in value in your balance sheet, and that is going to be represented down below in your finance buy as a revaluation reserve. And so that figure there, 352,307, is a combination of three figures. It is the difference between the new value, 1.1 million, and what the business or what the buildings, land buildings, were actually worth, which was the 870 minus the 12,150, which is 857,850. And then we added the 95,000 euro back in, and then we added the 15,157 in as well. And so altogether there, 352,307. Okay, so there was a lot to that land and buildings adjustment, but break it down sentence by sentence until you have each part finished and then move on. So that was that. We're on to the last adjustment now, provision should be made for the following. And when you see the words provision should be made for, I want you to think, okay, I've got stuff to do in the TPL here, and then I've got stuff to do in the balance sheet. So provision should be made for the following: rent due on the 31st of the 12th, 2024. So what's the story with rent? So expenses and revenues, you need to understand, you might see some adjustments about this. We have to remember that in the TPL, we have expenses and revenues for the current year. And then any expenses and revenues prepaid or due at the end of the year are recorded in the balance sheet as their E. So the adjustment says provision should be made for the following: rent due on the 31st of the 12th, 2024. So from our trial balance, we can see that the rent here, we've seen it already when we were putting the figures in from the trial balance. We can see that that is rent receivable, okay? So we have received rent from tenants, okay? And it's saying now rent due on the 31st of the 12th. So this rent receivable is rent for 8 months, up from the 1st of January through to the 31st of August, okay? So there's 4 months rent that's due at the end of the year. So we just have to work out how much money that is. So 8 months is 17,600. So divide that by 8 months, multiply by 4 months, gives us 8,800 that we have yet to receive from our tenants. But it is attributable to the current year, so therefore we will have to put it in to the TPL for this year, even though we did not receive it. And we will add that onto the rent receivable in the add operating income heading. And then in the balance sheet, you're going to have rent receivable due at the end of the year. That's going to be 8,800, and that is going to go into balance sheet current assets. So this is it. So rent, we're going to add 8,800 here, and that's 26,400 in the add operating income. And then in the current assets, you've got rent receivable due, 8,800 euro. And that is part 1 done. Part 2 then is just provide for the mortgage interest due and investment income due, and we've already got a lot of the work done here. So we had investment income due 2,100 minus 900 all worked out earlier, and that gives us 1,200. And then the mortgage interest due, we have the 11,450 minus the 8,150, and that gives us 3,300. Now, note 3 then says a bank transfer for 1,500 was made to a creditor in full settlement of a debt of 1,650. Okay, so bank transfer 15 made to a creditor. So 1500 left McConnell's bank account, so we would be crediting the bank account, so the asset bank would be reducing. It was made to a creditor in full settlement of the debt. So the creditor, the debt to the creditor has completely reduced. So 1,650 is going to go on the debit side of the creditor account. And now we need 150 on both sides, debit and credit. And so we are short, as you can see there, we're short 150 on the credit side. So if we had a discount that we're getting from our creditors, so we don't have to pay them the full amount, they're letting us off 150 euro, that would be discount received. And so obviously then that goes on the credit side. You can see from the extract from the trial balance below that the discount that we have is already on the credit side. So we will be adding that to the 9,900. So we'll be adding 150 to that. So this is how this is going to look in the accounts. So the bank is an overdraft and we have spent more. We've taken more money out of the bank account. So we are going to be adding that 1,500 to the bank, and the creditors are going to be minus 1,650. And then the discount in the operating income, we are adding 150 to that. And that is note 3 done. And then the last one says provision for bad debts to be adjusted to 5% of debtors. So we tot up what our debtors figure is in total then after all of the adjustments. So you see we had 2 adjustments to our original debtors figure of 73,500. So our total debtors figure there, 89,860. And when we multiply that then by 5%, because we've been asked to adjust it to 5%, we get that is €4,493. Now we compare that to what we already had, which was 3,600 in the trial balance. And unfortunately, this is a little bit more. So that means that is an increase in bad debts provision of €893. And so that is us. We are all done. All we have left to do now is tot up the total. So we are just going through our accounts from start to finish. We've worked out then our cost of sales here, 577,650. We take that away from the sales, we get 318,650. Then we have our selling and distribution, advertising. We tot them all up. All of the selling and distribution expenses, 43,943. Then we tot up all the admin expenses. We get 191,307. We add that to the 43,943 and we get 235,250 is all of our expenses, which we take away from our gross profit there. And that gives me 83,400. Then to that figure then we'll add all of our operating incomes, and then that gives me an operating profit of 123,050. I add my 2,100, I take away my mortgage interest of 11,450, and I get a net profit of 113,700. Then I go over to my balance sheet. I tot everything up. Be careful to tot all of your totals up here. Then we go down to our current assets. We tot everything up. We get 192,570 current assets. We tot up all of our current liabilities. We get 125,250. That leaves me with a working capital of 65,007 euro, which is a positive figure, which we add to my total fixed assets up there. And then I get my total net assets is 1444157. Then in my finance buy, I've got my 220,000 mortgage. I bring over my capital. I bring over my net profit here then from the TPL, and then I take away my drawings from the net profit, and then I get 1224157, which when I add to 220,000, I get 1444157. And so that is then the 2025 sole trader final account complete.